Hello, I'm Russ Mould, AJ Bell's Investment Director, and with me here today is Richard Penny, Manager of the Legal and General UK Alfa Trust. Now, we're going to talk to you about what a fund is, how they work, what they can potentially do for your portfolio, and what you should think about if you're contemplating choosing one. So, Richard, thank you for coming. I appreciate your time.
Thank you.
So, the first thing is, what process should an investor start to follow if they're thinking about choosing a fund or funds for their portfolio?
Okay, so what you're ideally trying to achieve is marry a fund and its objectives with what your own personal objectives are. So you need to know what you're trying to get out of the fund yourself. You need to sit down and decide how much money you might be prepared to lose. And there are times where in the short term you might lose money. And then over what period of time you might want to invest. And if we make that real for you, if you've just sold your house and you're going to need to invest another one in a year's time, then your objectives are going to be very different from if you're investing for 30 years in a pension fund structure.
So it comes down to an individual's personal goals,
Yeah.
time horizon, and appetite for risk. And you've defined risk as potentially losing your money. Is that fair to say?
It is, and I think that's the way that people experience risk is sometimes people will go into an investment, maybe haven't really addressed the facts, and if they see the fund down 10%, perhaps an equity fund, if it were to be down 10%, maybe an emerging market fund, they don't run the position for the full length of time, and I think people have done the numbers and proven that actually private investors do actually subtract value by this whole process of panicking out at the bottom. So you need to prepare yourself for all outcomes at the start of the process.
So once an individual's done their homework, thought about their strategy, decided that they're going to take some risk in search of better returns, how do they differentiate one fund from another or one fund management group from another? You've all got different styles, approaches, philosophies, I guess.
Absolutely. Well, first is what's in the fund. So different types of investments will marry well with different risk objectives. So if you're looking to protect the money because you want to take your house proceeds, invest it next year, you're probably looking at bonds or a money market type fund. If you're investing for the pension, you're probably in equities, and you might be edging towards smaller companies perhaps, or even overseas type equities. And I mentioned about people knowing what they were looking for. Also, you need to bear in mind that if you live in the UK and you're always going to be spending money in the UK, probably you're going to have a lot of your money in UK denominated assets, so priced in pounds, and that would reduce that element of risk.
Okay, that makes perfect sense. And so when people are trying to then assess how effective a fund manager is and whether they're worth the fees that we've discussed in a separate video, how much weight should they put on performance? Because obviously we only know what's happened in the past, we've no guarantee for the future. So is historic performance important, and how should people assess that?
Yeah, so with a performance record, you need to check that the performance record is relevant to the individual. And so if the fund manager has changed the fund, the record that's there would not necessarily be relevant unless it's a highly team-oriented process. If somebody's had a bad period, if it's 2 or 3 years, then they may be just about to have a very good period. But what you would ideally look for is a fund manager who's done well more times than not over a longer period, such as 5 or 10 years. And whilst it's possible to pick a very enthusiastic younger manager, you're just as likely to pick a bad one as a good one because there's no track record.
Okay, that makes perfect sense. And so that's one way in which you can look at a fund. Like obviously there's the cost, there's the return that you get on that investment. We could get really, really techie on you, and we probably don't want to do that and talk about things like Sharpe ratios and trainer and beta. We won't go there, I promise. But do you, as an investment professional, look at those things and benchmark yourself against them? And what do you think would, a newcomer say should really focus on, rather than getting perhaps too caught up in the details?
Yeah, so I mean, I think there's 3 key factors. I like to know whether the fund manager is invested in their own fund.
Okay, so they've got some skin in the game, basically.
I mean, most people will invest in an ISA every year, and if the fund manager's putting 10 or 20 grand in, is that really serious commitment in their own ability? I would suggest not. So you'd want to see a reasonable amount of money in there.
And do fund managers declare that as a matter of course, or is it easy for people to find out looking at the fact sheet? Or
there is a trend for that to happen more often, but generally where people are doing it, they'll make it public. As it happens, I have 2 concentrated funds I run that I've got a meaningful amount of money in both of those.
So that's one, is skin in the game.
The other element is how close to an index they are. You're getting slightly technical here, but index funds are a lot cheaper variant. If you're paying for an active manager, do you really want to pay for them to do something you would pay a lot less for?
Right.
And so I would say you want to go with people that back their own
That
best
take a
ideas,
view.
that are off that index, because otherwise you could just replicate the index. And then if people are really finding these ideas, I think it's better to have concentrated portfolios. And the three factors that I've mentioned there, the fund manager investor themselves, the concentrated portfolios, and the best ideas type approach, have all been demonstrated over the longer period by the academics to add value.
So concentrated, you would mean in that sort of 35, 40, 50 holdings?
Yeah,
or about that, because obviously an
not-
individual wouldn't be able to do that on their own.
No,
so.
it's not as low as 12, but certainly sort of 30 to 50 would be identified as a concentrated portfolio.
Perfect, Richard. That was very helpful. Thank you very much, and thank you for watching, and we look forward to seeing you next time.
Thank you.